Good afternoon, everybody, and welcome. My name is Steve Jewell with Community Giving, and we're really excited to have you with us here today as the calendar year continues to come to a close. Hard to believe. I'm going to give people a chance to get into the webinar. We have a number of people joining us today, and just want to thank each and every one of you for taking time out of your day to be with us on what we think is a fairly important topic um, because it impacts lots of nonprofits and charities across our region. And oftentimes, because things are always changing, it's great to be reminded about kind of what's happening in the world of philanthropy and what are some of the recent developments that are going on. So just giving people a second to gather and get in the room. Just a note, we are recording today's webinar. And so those of you who may need to step away or maybe can't be with us for the whole webinar, we'll be sending out a recording so you can watch it in full at your leisure and when it's convenient for you. So once again, welcome. My name is Steve Jewell with Community Giving, and we are a collaboration of several community foundations all working together in various communities around St. Cloud, Minnesota, Brainerd, Wilmer, Alexandria, Painesville, Carver County, and even out in Derby, Kansas is one of our partner foundations as well. So thank you all for joining us and being with us today. We are very excited to have with us Cheryl Morrison. Cheryl is really one of the top-notch estate planning attorneys and philanthropic attorneys who have a specialty in philanthropy, who I've known over the years. And anytime she's speaking at any event or a conference you might be attending, I would highly encourage you to take that opportunity to learn from her. She has 35 years of experience, and we have her resume and background was in the materials that was sent out ahead of time. So I'm not going to go through all of that, but just to say that I think you're in for a real treat. She knows and understands the field of philanthropy probably better than almost anyone I know. So as we go through today's presentation with Cheryl, if you do have questions, we encourage you to put them into the Q&A tab. We will have a time to go through those questions. But for right now, I just want to turn it over to Cheryl and thank her for being with us today and look forward to her presentation. Cheryl?
Great, thanks, Steve. I'm going to cover in this presentation, it is a presentation about recent developments. It's covering a lot of different topics in no particular order other than sort of how it felt importance to me, if you will. So this presentation will cover various cases, IRS pronouncements, analysis of those cases and how they, how they apply to the work that you're doing. I know we have some professional advisors on here and potentially some donors as well. So there's kind of something for everyone here. At the end, I have a bibliography of all of the things that I'll be talking about today. But with that, let's start with some of these developments and put them in context and apply them to the work that you are doing every day. Firstly, let's talk about gift receipts. And some of the presentation materials here are going to be pretty basic for potentially professional advisors, charities, but certainly for the donors on the call, the IRS is really big into substantiation and having the right records for the kind of gifts that you're making. If you're making cash type gifts, gifts from your paycheck, etc., there's record keeping you have to do in case you are audited to present those records that document the gift in some way, whether it's a bank record, pay stub, what have you. For gifts of $250 or more, a donor is going to need a contemporaneous written acknowledgement from the charity that acknowledges that gift. It could be electronic or mail, but it has to be received by the donor before the donor files the return or the due date for the return. In that receipt, the name of the organization to whom the gift was made, the cash amount, and a description of the gift should be included. And importantly for the charities here, but also for the donor, is that gift receipt does not value the gift if it's anything other than cash. The receipt really just needs to describe the property. It's up to the donor to document the value of the property according to the requirements in the Internal Revenue Code. But the charitable receipt really just needs to show what is it, describe what it is that was gifted. And also then a statement that no goods or services were provided. Or if there were goods and services provided, the estimated good faith estimated value of those goods and services should be included. And you'll see in some of the cases where some of these things were missing, the charitable deduction was denied. And in some cases, those were quite large gifts. So these requirements may seem very ticky, and you might be inclined to just say, well, it's close enough. In some of these cases, the IRS has not allowed close enough. So really important to pay attention to even the small details here. So for example, the Kiefer case, and again, there's a bibliography with the sites here. This was a gift to a donor advised fund. The court stated outright that statutes and regulations are really strictly applied in this area. And there was all sorts of documentation in that case that said that the charity, as required for donor advised funds, had legal control over the donated assets, but the document that purported to be the contemporaneous written acknowledgement did not contain that statement, even though other documentation associated with the gift did say that. So in that case, the court held that receipt was insufficient to support the deduction for that donation. So again, strict compliance of these rules. In the Albrecht case, the acknowledgement did not state that the charity didn't provide consideration. And in that case, again, just because it was missing that statement, the court held that the receipt was insufficient to support the deduction. And as I say, in some of these cases, the deductions were pretty significant. And so to think that one small little thing missing may jeopardize a deduction, that's absolutely true. So it's very important to follow all these rules. In the Brain case, there was a bargain sale of land to a township. There was a fair amount of negotiation and discussion around how this is all going to work, and backs and forths between the donor and the charity. And ultimately, there was an agreement at the end, a court settlement actually, because it went to court, that resulted in some rezoning that would benefit the donor in exchange for this gift that was given. In that case, the written acknowledgement failed to state that there was some benefit going to the donor as a result of this whole negotiation around the gift. And in fact, the receipt said there were no goods or services provided, but that wasn't correct because the donor received a rezoning accommodation that was associated with the gift, and the receipt didn't state that. So the receipt was insufficient. In the Eisen case, it was a gift of an airplane, and just FYI to folks out there, there are very special rules that relate to gifts and substantiation for planes, boats, vehicles, etc. There's a whole publication on this. But in that case, the receipt was missing the donor's name, tax ID number, and that statement about goods or services. And the court denied the deduction because the receipt was missing those pieces. So both for the charity and especially for the donor, who really has the skin in the game here in terms of the deduction, really important that the receipts and documentation are sufficient. Another part of documentation can be appraisals. And appraisals are not required for cash gifts or publicly traded securities. So As you think about publicly traded securities, we'll cover a case in just a second about cryptocurrency, for example. And the cryptocurrency isn't a publicly traded security, nor is it cash. So an appraisal would be required for a gift of that kind of property. There are some exclusions for inventory, and that's because when somebody's gifting inventory to charity, the deduction is only available for the basis in that property, not for its fair market value. So an appraisal would not be relevant there. Also, if it's non-cash property valued less than $5,000 for donation purposes, an appraisal is not required. But otherwise, if it's valued more than $5,000 and doesn't fit one of the exclusions, an appraisal will be required. Again, these requirements are very, very tricky, and just missing some of these things can cause the deduction to be denied. So important that the tax preparers, the donors, know what these requirements are. There's a regulation that states very clearly what the requirements are. And so I recommend that the tax preparer working with the donor and the appraiser get out that regulation, sit down with it and check off, do you have everything needed in this appraisal? So, for example, you have to have a qualified appraiser, more on that in just a second. There are some timing requirements. It has to be received before the due date for the return on which the contribution is claimed. It can't be paid for with a prohibited fee. And again, all of these are in the regulations. And so it really is just for the taxpayer to make sure that the taxpayer and the tax preparer are up on these requirements. With respect to the timing, if the report is signed before the date of the gift, it can be no more than 60 days before the date of the gift. If it's done after the date of the gift, then the appraisal has to value the gift as of the date of the contribution, at the date of the contribution. If the appraisal report is submitted before the contribution, the report has to state the expected date of the contribution, and then that needs to be the effective date of the report that the appraiser prepares. From a content standpoint, that appraisal really needs to describe the property sufficiently so that anybody reading it, even someone who's unfamiliar, can figure out what it is that we're talking about. If it's something physical, like a tangible item or real estate, then the condition of the property has to be described as well. The date of the contribution, as I mentioned, has to be stated, whether it's an expected date or an actual date, depending on when the report is prepared. And the statement that the appraisal is prepared for income tax purposes is required to be in there. So again, very tricky requirements, and it really pays to sit down with the regulation and make sure the appraisal qualifies. The appraisal has to cover if there's any agreements about how the property will be used or restrictions on the property, etc. Any of those that may affect the value of the property need to be described and evaluated by the appraiser. Obviously the name and address and the EIN of the appraiser and his or her company should be included as well. The appraiser has to include the appraiser's qualifications, and those are really, background, experience, education, memberships, etc. in the appraisal. There's a specific declaration that has to be in the appraisal. Again, stated very clearly in the regulations. And then the appraiser obviously has to get at what is the fair market value of the property on the valuation date. How did the appraiser get to that value? What bases did he or she rely on? What was the method? Was it an income method? Was it an asset method? How did the appraiser arrive at all of that with backup materials and sources? So who's a qualified appraiser? Well, somebody who's earned an appraisal designation from a recognized organization. Somebody who has education, meeting a certain amount of experience and knowledge, if that education is obtained from either professional or college level educational organization, professional trade or appraiser organization that offers programs in valuing that type of property, or from an employer if there's like an apprenticeship or education system going on with that employer. And this experience and designation has to be in the type of property involved here. You can't have a real estate appraiser appraising jewelry or vice versa. They really have to have the experience and knowledge in the area of the type of property involved, and they have to be able to document that. There are some people who cannot be appraisers, the donor or the taxpayer, the donee, any party to the transaction in which the donor acquired the property, unless 2 months have passed and the value is not any more than the donor paid for it. An employee of any of these folks, relative of any of these folks, or somebody who appraises regularly for the donor but not for other people. A case that, this is really a good case. It's just full of analysis and information that is really helpful to lots of issues that we're talking about today. In the Hohenscheid case, this there was a financial advisor who was advising on the sale of a company where the stock of the company was gifted to charity, and there was a charitable deduction taken for that by one of the company owners. He was the one who said he was an appraiser, and the court said, you are not a qualified appraiser. He did not hold himself out as an appraiser. He wasn't certified as an appraiser. He didn't do appraisals, and so he was not a qualified appraiser. Here, if you look at the case, there was a series of communications and documents and things that the court looked at. Really interestingly, the court delved quite deeply into all of the communications leading up to the donation and leading up to the sale of the company. The donor here was trying to make a charitable donation ahead of the sale of the company, so that the donor could exclude the gain on the sale of the company. And those communications were not overly favorable. For example, there were blanks in the dates of the assignments of the stock. There were emails with the donor's counsel and accountants and the charity involved saying that he didn't want to, pull the plug on the gift until the very last second. All sorts of facts that went against the donor's claimed date of contribution. And the court decided the contribution didn't actually happen as, at the time the donor stated, and instead it happened a month or so later, much closer to the actual sale of the stock that was consummated. And so consequently, the appraisal that used the donor's stated date of gift was not correct, because the court ultimately said that wasn't the date of the gift. The date of the gift was actually somewhat later. And so the appraisal was not correct according to the court's redetermination of the date. It did not satisfy a lot of the other requirements, didn't sufficiently describe the stock. It did not say it was prepared for income tax purposes. And the court said the appraisal was just insufficient to support the donation. The Schweizer case involved a donation of sculpture. The donor tried to get a statement of value, applied for a statement of value from the IRS, but he didn't get it in time for the return and the appraisal to be filed. So the donor had a dealer prepare a very simple valuation, not attached to the return, but the court held that the dealer was not a qualified appraiser. He'd never prepared a fair market value appraisal before. There was also the form 8283, which is another form that needs to be filed when there's a gift of property over $5,000. that document did not contain a description of the gift or really any information about it that was asked for. And so the court held that all of that documentation was insufficient to support the donation. On this topic of cryptocurrency, there is IRS document cited there that said that an appraisal is required for cryptocurrency because there is not a recognized exchange platform like there is with the stock exchange for publicly traded stock. So you can't just use the value as shown on the cryptocurrency trading platforms. Instead, a qualified appraisal is required. The Bass case simply says, I mean, again, just occurred more recently, that donations of similar items throughout the year have to be aggregated for purposes of the threshold requirements for this, $5,000 threshold, for example, for appraisals. Another appraisal case, this was a case that involved a donation of land by a company, and the company had originally held that land plus other land for development, and the court held that this company donating land was really donating inventory because the land was held for development. It was like inventory in a manufacturing firm of its widgets that it creates. And so the court held that because it was inventory, it was deductible only at the basis and not the fair market value. And this case is interesting because it cites a good test for determining if property is held as inventory for sale to customers in the ordinary course of business. And this, obviously applies to developers, but also could apply in other circumstances with other kinds of property. Couple things this past year or recently happened with respect to charitable remainder trusts. This PLR from the IRS, we don't see a ton of CRT developments coming out because there's, approved forms, there's, people are generally following those forms. There's just generally not a ton of controversy around CRTs these days. Although there are some abusive sort of syndicated things out there that you can get in trouble with. But this was one that was interesting because the CRT document itself provided that the trustee could allocate between with that unitrust payment at the beginning of the CRT between the spouse and charity in the trustee's discretion. And the court held that neither the charitable deduction nor the marital deduction was allowable because of that ability of the trustee to make allocations of the unitrust amount. Now, that's apparently in conflict with a couple PLRs that the IRS has issued previously. So we may see something come out on this topic in the future. I think my main comment about this is, that it's probably best with charitable remainder trust just not to try to get too cute. Follow the forms, do the, sort of easy, clear type of structure. And it's much easier to stay within the right lane and not get into trouble. Couple thoughts on IRA charitable rollovers this year. Lots of folks are familiar with these. They've been around for a while now. For donors 70 and a half or older, they can make a direct rollover from an IRA, not a 401k or 403b, has to be an IRA, up to $100,000 a year. And what's interesting here is that with the Secure Act and over the last year or two, the required minimum distributions age has been raised now to 72 and will be going up again. But they didn't change the age at which folks can qualify for doing this qualified charitable distribution. The difference between those two ages is just that with a donor doing a qualified charitable distribution who's 71, when the required minimum distributions don't start till 72, it's just that that donor won't get to credit the distribution against his required minimum distributions because he's not 72 yet and doesn't have required minimum distribution. So a little bit of a difference there that may mean something to some people, may not. This type of qualified rollover or QCD has some other qualifications. You know, there has to be a contemporaneous written acknowledgement like we started talking about for a transaction like this. Starting in 2024, the plan is to index the various dollar amounts involved for these that we'll talk about. So we'll just have to see how those happen in the future years. This kind of rollover not be made to a private foundation or a donor advised fund, but just to public charities. But here recently in the 2023 Secure Act, it was finally allowed after much lobbying over many years. The law was changed to allow qualified charitable distributions to be made to a charitable gift annuity or a charitable remainder trust. The numbers aren't huge. Some people are using these. The maximum that a taxpayer could do is $50,000. And that would count against the 100,000 total limit for qualified distributions. Spouses can combine their 50,000s into, one charitable remainder trust or one joint charitable gift annuity. The regular charitable gift annuity CRT qualifications would still apply in that they would otherwise have to qualify for an income tax deduction, even though there isn't an income tax deduction available for a QCD. The payments from the CGA or CRT have to be taxable at the ordinary income rate of the recipient. That would be normally true anyway. There are some requirements that only the participant and spouse can be the beneficiaries of these planned gifts into which QCDs can be made. With a CRT, it has to be a new single-use CRT. All it can hold is these rollovers. So for some people, a $50,000 or $100,000 CRT and the startup cost and continued administration might make this a little less attractive. On the other hand, I've heard of people, just really having programs to help donors do these efficiently. And so, so they may be making hay with this new change in the law. Normal other requirements still exist. The payout has to be 5% for a CRT. A CGA, of course, doesn't have a minimum payout, but, looking at the tables and the annuity rates and the annuity amounts, it may be that you have to be careful depending on the ages for a joint CGA. And you can't defer a CGA of this ilk for more than 1 year. So, a fair number of requirements, but this may be an option for some year-end planning for some folks. Another issue that came up in a number of the cases recently is the prearranged sale issue. And what this is a donor who is looking to donate capital gain property, so property that has appreciated over time. A donor who is looking to donate that kind of property is looking to get a fair market value deduction for the gift of the property, but also to not recognize the capital gain that is built into that property. If the donor bought a piece of stock for $50 and donates it when it's worth $100, the donor is trying not to recognize that $50 capital gain and pay tax on that, and instead just to get a fair market value deduction without recognizing that gain. The prearranged sale idea is a concept that the IRS applies in lots of other contexts, but in this context, the IRS can take the position that if the donor has already arranged the sale of the item that is going to be donated and just turns around and makes the donation prior to the sale, even though the sale was something the donor had already arranged, then the IRS can turn around and make the gain on that sale taxable to the donor, which is what he was looking to avoid in the first place. So that's, for donors, again, this issue is something a charity can help flag if a charity knows this issue exists. But this is really an issue for the donor and the donor's tax advisors, because the donor is the one who's going to suffer the consequences if this issue comes up in the donation. And so this concept, it's reasonably common. I would say I deal with it once a month in my practice with charitable gifts. And so it's a relatively common issue for donors who are looking to make charitable donations, but also know that there's a sale of the asset in the wings. The Hohenscheid case that we talked about before dealt with this type of issue. The court said there isn't a bright line test. You just have to look at different factors to determine, is it a prearranged sale? So does the donee charity have an obligation to sell? Have the parties, the seller and the buyer of the donated property already taken efforts to consummate the sale? Are there any remaining contingencies of the sale? What are the timing here of the sale to the gift? What is the timing of the corporate formalities? In the Hohenscheid case, it was a gift of corporate stock, so they were looking at corporate formalities. This issue can arise in real estate. This issue can arise in art. There's all sorts of contexts in which there could be sort of a sale waiting in the wings, but the donor wants to make a gift first so that he avoids that capital gains, knowing that there's a sale in the wings. The Hohenscheid case is interesting, not only because of all of the ins and outs of the facts, all of the evidence that the court looked at, even looked at communications between the donor and his counsel, the donor and his accountant, the donor and the charity, all really delving into all of those things, that the court held that in this case, it was a prearranged sale because the company had already taken lots of steps toward the sale. These communications said the donor was going to wait until he was 99% sure the sale was going to go through. Lots of bad facts here. But what's interesting about this case is that the IRS has a test out there that says that, the test for determining if there's a prearranged sale is whether the donee charity has an obligation to sell after the gift or once the gift is made. And there is kind of a long line of cases that have whittled away at that bright line test to look at factors and to look at whether it's a practical certainty that the property will be sold. So there is this bright line test that lots of donors want to rely on and lots of donor advisors want to rely on. But there is also this line of cases that has said, if there are bad facts, that bright line test may not be a bright line. It may instead be something where we have to look at the various factors and was it 99% certain the sale was going to go through, so there's a practical certainty. So the waters are muddied more than donors and sometimes their advisors would like to acknowledge in this area. Again, really, you may just want to look at this case. It's just a really good case for this issue on prearranged sale, especially donors and their advisors. The Kiefer case is another prearranged sale case. Again, this is something the IRS looks at. In this case, the donor assigned a partnership interest. It was a real estate partnership to charity, but there was a side agreement where the donor said, you're only gonna, I realize I'm giving you a full partnership interest, but you're only really gonna get the proceeds of the sale of this one piece of property and not any interest in the rest of the property of the partnership. In that case, the donor said it was a prearranged sale and lots of other legal issues around that, but the donor was taxed on the gain of that sale. A couple cases in the not too distant past having to do with a donor's ability to raise issues in court for gifts, particularly restricted gifts that may have gone wrong. And under Minnesota law, it's the Attorney General who has standing to argue these cases in court. And typically the donor does not have standing. This is kind of a long-standing concept in the law of charitable gifts around the country. There is a case, at least out there, that said that if the Attorney General doesn't appear, then someone else who has a special interest in the gift could appear in court to argue about the gift. And so that's the Minnesota state of affairs. It is the case that if a donor argues about the use of a gift, a court is going to be really reluctant to return the gift to the donor, and instead more likely to order that the gift be used in some other way for charity still. And part of that is the donor has taken a charitable contribution for the gift, so the donor really shouldn't get the gift back. And Minnesota law under the Uniform Prudent Management of Institutional Funds Act, UPMIFA, and Chapter 501B both say that the gift can't be returned to the donor. It really just must be used for other charitable purposes. And so there's a case coming out of or involving Dartmouth where the court continued to hold that a donor does not have standing to come to court to argue about the use of a gift, and only the AG does, the Attorney General. There's a Minnesota case, gosh, probably about 4 or 5 years old now, the Lindmark case, that says similarly that it really is up to the AG to pursue gifts gone bad, if you will. I think, you know, in sort of summary or conclusion, and I think we'll have some time for Q&A here, but I guess what I want to get across to anybody attending this session is that, you know, the IRS pays attention to these charitable cases. The developments are frequent and often go against the taxpayer. The IRS is focused on abuses and deficiencies, you know, even down to the ticky little requirements of appraisals and gift receipts. And they really do apply these rules strictly. So it's very important for a donor who's really got the most skin in the game here to be working with the donor's counsel or accountants to really be sure that the T's are crossed, the I's are dotted. From the nonprofit or charity standpoint, the more you know, the better you can help your donors wend their way through making a gift to you. And while you really cannot give legal or tax advice, you can be aware of these issues and cognizant of them so that you could raise a flag and tell a donor to think about that issue more carefully and consult his or her advisors about those kinds of issues. And based on that Hohenscheid case, I think one takeaway is that communications about gifts are sometimes better had, you know, over the phone rather than, you know, having a whole huge record that maybe someone can poke a hole at down the road in terms of, you know, discussions that were had, because clearly a court can review those things. So really, those are the takeaways that I think are useful for today's session. And with that, I'll close.
Well, thank you so much, Cheryl, for sharing your expertise with us. My name is Sarah Carlson. I'm the Executive Director of the Wilmer Area Community Foundation, and I'll be moderating some Q&A here for a little while we have Cheryl's expertise still with us. So if you do have a question that you'd like to pop into the Q&A tab or do use the chat feature, please go ahead and do that right now. Cheryl, one question that did get direct chatted to me was relative to something you just spoke about. And that is there a look back time frame that applies if a land gift is donated, receipted, and appraised at a higher value than it actually liquidates at, where the IRS would take another look at the differentiation between the gift that was claimed and when it liquidated for charitable use?
Right. Well, there isn't anything in the law that says, here is the time, or here is what the IRS should look at, or here are the issues. There are a couple forms that have to be filed that would certainly be helpful to the IRS in looking at that issue. So there's a form 8283, which is signed by the donor and the appraiser and also the charity, that basically, and when the charity is signing it, they're not, alleging as to value. They're simply saying, we received this gift. And it's up to the donor and the donor's tax preparer and the appraiser to work on the rest of that form, which is what is the basis, what is the value, all of that. And so for a gift of $5,000 or more, this form 8283 is completed and filed. That does show both the basis in the property and the value of the property for purposes of the contribution. The charity is required to file a form 8282 if it disposes of property within 3 years of the gift. So that would be a tool the IRS could use to look at, wait a minute, the donor took $1 million deduction for this piece of land, but when the charity turned around and sold it, they sold it for only $500,000. So it would allow the IRS to connect the dots. I don't know offhand if there's any sort of research on how often the IRS does that or any data on that. I'm not aware of it, but there certainly is a mechanism under which the IRS has a tool out there that's just absolutely required that they could use to double check on those kinds of things.
Thank you, Cheryl. There's another question here that says, how do you think the challenges such as the lack of staffing and support at the IRS are impacting enforcement of regulations in the charitable gifting space?
It is very hard to tell. I have to assume that some things get, probably many things get through, that if the IRS had, 80,000 more people, maybe they could do a little bit better screening on. On the other hand, there's certainly some kinds of gifts that the IRS is really all over. Conservation easements. Every couple weeks, there's an IRS case on conservation easements that they've disallowed the easement for one or another reason. When there's abusive tactics that are used, the IRS, is all over those. So, you do see them getting really aggressive in some of these areas. It's interesting to me in sort of this receipt area, how many cases the IRS has heard, or the courts have heard, or the IRS has pronounced on in those kind of areas. But most cases, of course, don't go to court. So anything that goes to court is going to be just a few out of many. So it's not entirely clear to me how much of this the IRS is really getting the taxpayer on, where maybe 3 or 4 cases a year come out.
A secondary question is, do you think that AI, artificial intelligence, will be used for the future, in the future by IRS for enforcement in charitable abuses?
That's interesting. I being one of the least technical people in the world, I don't, it's hard for me to sort of understand where exactly it might happen. The IRS already uses computer analysis on tax returns generally, and to sort of pick up, are there things they should look at, or are there things that don't match, or things like that. And so it's not clear to me how that level of review would be enhanced with AI. But you certainly could see it coming, but again, I'm not technological enough to understand exactly all the ins and outs of how it might work. But you could certainly imagine that if the IRS had an opportunity, they would take it.
The next question is, what is the preferred process for valuing a gift of marketable securities? So can the donor look up the beginning and end of day pricing online, or do they need to get a letter from the selling agent who handled the receipt on behalf of the charity?
So the value for marketable securities is the average of the high and the low on the day the gift is made. The day the gift is made is not the day the donor told his broker to make the transfer. The day the gift is made is when the stock lands in the account of the charity or its agent. And so that's number one in the equation, is what is the day of the gift? Well, that's the day of the gift. The donor is going to have to find out what that date is, right, to do the valuation. And then from there, it's just math, average of the high and the low on the day of the gift. There isn't, you aren't going to get probably a letter from anybody the IRS recognizes is authoritative, but for the IRS, it's just math as well. There is, so if they know the date of the gift, and here's the high, here's the low, here's the average, just having something that shows that calculation on the income tax return is going to be sufficient. Now, when we do tax returns, we don't do a ton of income tax returns at all, but we do gift tax returns and we do estate tax returns. And there is a computer program called eval that the IRS uses when it's going to value publicly traded stock. And that computer program, if you tell it, here's the CUSIP number of the stock, here's the date, we're worried about, it will tell you what the average of the high and the low is. And something that is sometimes missing is that there could be a declared but unpaid dividend that is part of the value of that security. And the eval program will tell you that. Whereas if a donor's just, looking at the stock quotes, I don't think you'd see it, but that is certainly part of the gift that the eval program will tell you. I can tell you that we have access to that program. Probably many tax preparers do as well. And if they don't, then they're just going to have to craft up a description of how they arrived at the value.
Thank you, Cheryl. There's a clarification question here relative to the Bass case.
Mm-hmm.
On recurring similar gift items needing to be aggregated in an appraisal.
Mm-hmm.
And they're asking if you could clarify, would this apply if a family was gifting dad's coin collection or stamp collection? Is it the collection seen as a whole, or does each item have to be evaluated and appraised?
That is a good question. I'm not going to be able to give you an exact answer. I suspect there are cases or IRS rules on that, that to me is a different question, because in that case, you know, when you're talking about a collection versus each item, there may be an element of the fact that it's a collection. It's almost like you're going the other way. I'm trying to think of how to explain that. So with a collection, you have each item, but it might be worth more as a collection than the aggregate of each of the items. You're going to get an appraisal, right? And an appraiser might find authority for aggregating the values into the value of the collection. As a whole, I just don't have access at the moment to the rules on that. What I was quoting was having to do more with, for example, you bring your designer suit to Goodwill in March, and then you bring another one in April and another one in, you know, May, and every month, and you try to split them out for purposes of the, you know, the donation. But what the IRS is saying is if in the aggregate, those things are really kind of all the same, then for purposes of whether you're at $5,000 or more and need an appraisal, you have to aggregate all of those. So that's kind of where I was going with it. And I think that same concept would probably apply with the coin collection issue, that, you know, if you're donating it all at once, right? I think the answer is if the aggregate value of all of those coins is greater than 5,000, you probably need an appraisal.
Thank you. Another question is regarding increased federal regulations emerging, or some tax law or charitable fixes, i.e. fixes that you might see on the horizon, relative particularly to donor advised funds. So fixing the provision against the IRA rollover directly into a DAF, or requiring minimum distributions out of DAFs. Do you have any thoughts on that?
Well, I think there we go. I was going to say, I think I was frozen for a second. You know, there's been a lot of concern about DAFs in general, and you know, the thinking or reason why is, you know, they're kind of an end run around you know, a private foundation that has distribution requirements, if you will. I mean, the IRS really says that if you're going to get a charitable deduction, it ought to go to charity, right? And so, okay, if you're going to set up a private foundation, we get it, but at least 5% has to get distributed, right? And there's no such requirement with DAFs. And so they're kind of a loophole in a way that they aren't necessary, those funds are not necessarily ending up with the end charity, you know, very quickly. Now you'll see some studies out there by the DAF sponsors that say, in fact, they're distributing much faster than 5%. So, you know, nobody, the IRS, the government shouldn't worry about them. And yet there are still lots of people out there who think they're still in abuse. Because technically you could give funds to a DAF, take a deduction, and no charity ends up with those funds for, you know, any definite period of time. So I do see that as being a continued area of discussion. On the other hand, that's been happening for 10 years, 15 years, 20 years since the DAFs became really popular. So I don't know if I see real action out there. You know, I have mixed feelings about it personally, but as I say, I think it's, I think the proof is that they are distributing, maybe, so they, you know, aren't viewed so much as an abuse, but that you do still get critics who, you know, think something ought to be done, if you will. So, but I can't predict on whether I think it'll happen or not. hasn't happened for a long time. So,
Well, thank you, Cheryl. That wraps up all of the submitted questions that we have from the audience. And if we have any that come in, while we morph to the next stage of the program, I'll certainly make sure that we try and get those to
great.
you. But thank you for sharing your expertise and for hanging in there with us. We certainly, as a DAF provider ourselves here at the Community Foundation, understand those donor advised funds, and our payout rates are closer to 20% out of our funds. And that's the case usually in community foundations across the country. But we do also worry about the assets that are not being used for charitable good.
I think that's right. I think that's right.
So thank you very much. I'm going to now introduce my colleague, Terry Foster, who is the Executive Director of the Brainerd Lakes Area Community Foundation. And Terry will be starting to tell us a little bit about how your community foundation works with the provider network, donors, and our referral sources in the professional advisors. Terry?
Thank you, Sarah and Cheryl. As Sarah just mentioned, I'm Terry Foster, and I will be sharing some information about what a community foundation is and why you should maybe consider opening a charitable fund with us. A community foundation is a 501c3 that typically focuses on supporting a specific geographic area by facilitating and pooling charitable funds to help meet community needs through grant funding and connecting donors to support local nonprofits in their important work. In essence, a community foundation helps generous people transform lives and communities through philanthropy. You may be wondering who Community Giving is and why you see the brand attached to this presentation and the 6 local community foundations you will hear from today. Community Giving is a collaborative initiative between local community foundation partners in which Community Giving provides the proven framework or the secret sauce, if you will, to support and help community foundations be successful. This collaboration allows us to operate more efficiently and focus on local philanthropy, our local community needs, and our donors. Why should you consider partnering with a community foundation? We are local. We strive to understand what our local community needs and priorities are. And we keep your philanthropy dollars local by keeping the dollars in action through our local economy with our businesses and nonprofits. We also strive to provide concierge level service to our donors by listening to their needs and recommending a fund or solution to meet their charitable goals, and when possible, provide a bonus of reduced capital gains or tax. Professional advisors may want to consider partnering with us and also broaching the charitable giving topic with their clients. Because it has been proven through the U.S. Trust study in some of their research that in talking about charitable giving and what their clients' goals are for their wealth now and in the future helps to build relationships, also increases referrals for those professional advisors, and also helps their clients ensure that their wishes are met now and even after their passing. Now that we've talked a little bit about a community foundation, we'll talk a little bit about fund options and what types of funds are available through your local community foundation. There are typically 2 types of fund options, endowed or flexible. An endowed fund is probably one that most of us are familiar with in that it is intended to last into perpetuity and usually only provides a specific percentage to be paid out each year, such as 5%. And this percentage is intended to preserve the principal of the fund so that it will continue lasting into perpetuity. Another fund option, though, is a flexible fund, in which many of our funds are that we hold locally at our community foundation. A flexible fund is exactly what it sounds like, flexible. It allows the fund holder to pay out all or part of the fund as a grant to any U.S. qualifying 501c3 school or government entity. It also allows the donor or fund holder to use it as more of an endowed type of fund if they wish, while still giving them the flexibility of using all of it if they come across a project or have a specific cause that they would like to support. As I mentioned earlier, donors do not necessarily need to know specifically what type of fund they want or how to establish one. Hopefully, your local community foundation can listen to your needs and your wishes and help offer a solution that will meet those needs and kind of direct you as to what type of fund might work best for you. A fund may be invested to create an even bigger impact. So usually when you put money in, the assets or non-cash assets, the fund is invested, creating a bigger impact for you to be able to grant out. Fund types include agency funds, which are typically established by a nonprofit and may be used as an endowed fund or as a way to invest the reserve funds. A field of interest fund is typically for a broad purpose, such as youth, arts, etc. A designated fund is usually one that is an endowed fund that is specifically designated to one particular charity or a group of charities, and that they will receive an annual payout, if you will, each year. You can also set up scholarship funds. This is a great educational, usually endowed type of fund to support 2 or 4 year educational scholarships for youth going on to higher education. And then the donor advised funds, which we are talking about today. Donor advised funds are a great tool. And again, donor advised. So the donor gets to advise where those funds go. A lot of times they can put the money into the funds, receive possibly a tax deduction, and then they can decide at a later time which charities they want to support with that donor advised fund. And we also have an unrestricted fund. Unrestricted funds for charities typically are used for, they don't have any strings attached. They don't have any designations, if you will. They can be used for operations or whatever the charity sees as the best use of those dollars to help them grow. Now that we've covered all of that, I would like to turn it over to my colleague, AJ Collier with the Alexandria Area Community Foundation. And she will share a little bit about how to give cash or non-cash assets to help facilitate and execute a fund.
Great. Thank you, Terry. As Terry mentioned, my name is AJ Kohler, and I am the Executive Director for the Alexandria Area Foundation. Now, she mentioned, I'm just going to go over quickly the assets that people can give. So first, starting with outright gifts, people can give cash, property, and stocks that can be used to make gifts to either establish a fund from the creation or to add to a new fund. And when individuals donate property or appreciate or closely held stocks, they may be eligible for a tax deduction based on the fair market value, and they may also avoid capital gains and estate taxes. Next, I want to quickly go over bequests. Naming community giving or any of our partner foundations as a beneficiary in a will is often the easiest way to make a significant gift. With life insurance, if a donor wishes to name community giving or again, one of our partner foundations as a sole or partial beneficiary of a life insurance policy, the charitable proceeds of that policy may avoid both income and estate taxes. Another option is to transfer the ownership of the policy over to community giving. And by choosing this option, donors may take income tax deduction approximately equal to the policy's surrender value. Now I want to talk about gifts that can help the donor now, but help charities later. So Cheryl did a great job of going over like some examples with the Charitable Remainder Trust and charitable gift annuities. So I just want to briefly mention that. With a Charitable Remainder Trust, cash or property is transferred to a trust, which pays the beneficiary either a variable income equal to a fixed percentage of the trust's fair market value, and the value is determined each year on a fixed annual amount. But upon the death of the beneficiary, the foundation receives the remaining assets, assuring that they will be used for the purposes that were specified by the donor. Then with a charitable gift annuity, cash or other property is contributed to the foundation in exchange for a commitment to pay the donor or the other beneficiaries as specified annual amount for the remainder of the beneficiary's life. And then deferred gifts annuities are very similar to charitable gift annuity, but the payment of the income is delayed until a predetermined time. So that's the difference. And then finally, with our retirement plan assets, using IRAs and other retirement plan assets is a thoughtful way to make a charitable contribution. It can provide a donor with a few significant financial and tax advantages. Unlike many assets, though, retirement plan assets are potentially subject to both income and estate taxes, but naming community giving or any of our partner foundations as a beneficiary of a retirement plan can eliminate estate and income taxes if the gift is structured properly. As you can see, of all these options that I just went over, generosity comes in many forms, and it's really our pleasure, all of our executive directors in our communities, it's our pleasure and privilege to help people find ways to get the most out of their giving. So that's really what we're here for. Now I would like to introduce Greta Stark-Crocker. She's the executive director for the Central Minnesota Community Foundation.
Thank you, AJ. I'm Greta Stark-Crocker, as AJ said, the executive director here at the Central Minnesota Community Foundation. And my area here is to talk about how we work with professional advisors and their clients. So we really, when we're working with professional advisors and their clients, we want to make sure that the professional advisor relationship stays with the client too. So we work together as kind of a vehicle to help professional advisor and their clients. So when we get donor advised funds, a lot of times they come from professional advisors, accountants, attorneys, financial planners. They may be meeting with a client to talk about estate planning, or they may have sold a business or have some appreciated assets such as stock that they want to donate and be philanthropic. So what we do is we sit down with the donor, and sometimes the advisors in the meeting too. It just depends on how the advisor and client want to do the meeting. And we just talk about the options and how it works with the community foundation. What's the philanthropic goals that the donor has that they want to achieve by setting up a donor advised fund. It's very simple to set up a donor advised fund. We meet with you, we talk about your needs, your goals, what your plans might look like for a succession plan, and we just talk through all of those items. And we do a little bit of paperwork, and then what we do is we take that information back, we draft a fund agreement, we send it to the donor to sign, and then we have them return it to the foundation. Once we do that, and then we send it up to community giving to get the additional signatures on the fund agreement and send a welcome packet along with the fund agreement back to the donors. In the meantime, we're working through the process with the donors to answer any questions along the whole process to get the fund set up. And our help doesn't stop once the fund is set up. We believe in concierge level service. All of our foundations do. We believe in working with our professional advisors and clients and getting to know them closely so we can help with their philanthropic journey. And the donor gets the tax receipt at the time the gift is made to the foundation. And then they can make their grants out whenever they want. So if they set up a donor advised fund and they're not ready to make grants right away, maybe they're new into philanthropy or they aren't sure where they want to give to, we can also connect them with needs in the community. With that, I think I'll turn it over to Randy to talk about how we support clients once the fund is established.
Great. Thank you, Greta, and good afternoon, everyone. As Greta was noting, there's several different ways that we support our donors through community giving and our local foundations. I'm just going to quickly cover a few more of those areas that can assist and provide opportunities for that support, including our donor portal, assisting with grant making, providing options for donations, and helping the donors connect to the community. Our donor portal provides fund holders online access to their fund information. Instructions on how to request login credentials are included in the welcome packet that Greta just mentioned. Once the credentials are created, the portal can be accessed from the community giving homepage by clicking on the Access Your Fund button at the top of the page. Just went through this process myself. It's very simple. It's very easy. It's pretty straightforward. Actually, just took me a couple of minutes, and I was into the portal. So, easy way for fund holders to be able to access the information. Once logged into the portal, the fund holder will have access to their balance information, grant and payment contribution history, fund statements that are actually flexible. You can pull them as you wish by using the date range filters available within the portal. And certainly we have a capability to submit grant requests from the donor advised funds. So no forms to fill out. You can just go straight in, select the organization or select a fund if it's already established that you wish to grant to. So again, a very easy way to do grants with the access through the portal. Grant recommendations can be made to qualified 501c3 nonprofit organizations, government entities, schools, and churches. So that was mentioned earlier. So certainly there's a large list of organizations to choose from. And we look at just Minnesota alone, there's over 7,000 nonprofits across the state. So add in anything that's national or even some internationals, and you've got a whole choice as a donor and a fund holder and where you want to request a grant. All of our grant requests are actually reviewed and ensured that the grant recipient is eligible to receive the grant before it is actually issued. So we use national services to actually validate the status of the recipient and ensure that all the requirements have been met. From the portal, our minimum grant request is actually $250. So quite low. Allows you to make those grants again directly to organizations or to funds that are set up within community giving. We provided a variety of donation options. Now, this isn't just for fund holders, but for anybody that include donations via credit card through our website, checks that are made payable out to community giving, but certainly any donations coming in, making sure that people are notified where they want those funds to go. Those can be mailed into our office. And then there's a number of other options that AJ just covered. Certainly, I recommend that you do contact your executive director with any questions that you have to discuss any different donation options. In closing, I encourage donors to engage with their local executive directors to discuss any opportunities to connect with the community when needed. As already's been mentioned, we're here and serving trusted local leaders who are actively engaged in our communities in working with several different organizations. We're involved in a number of community initiatives and projects and events, and are also, through all that engagement, become very aware of what the needs may be in the community, that we can match up donor desires with community needs. And certainly as a collaborative team, we do have our geographic areas that we do service, but we're very collaborative across our executive director team and across the foundations. And we always put the donors first when we work together on regional needs, or in a number of cases, we've got donors that actually cross multiple communities. Just use one example that came up recently, where we have a donor that grew up in Paynesville, owns a business in St. Cloud, but lives in Alexandria. That donor has a lot of interest in being engaged across all of the communities. So there's no one right choice. We put the donor first, and certainly in this case, working with them to make sure that their philanthropic needs and desires are actually met. So we work well together as a team, and certainly don't use our boundaries as defined for for our foundations as limitations. So with that, I'm going to turn it back to Sarah for some Q&A.
Thank you, Randy. I appreciate that. I do have a few questions for the executive director team. And if our viewers and audience have any questions, please again, pop those into the Q&A tab and I will keep an eye on them or direct chat them to me. So the first question is for Terry. Terry, is there a fee for a donor to meet with foundation professionals to explore fund options or set something up? And is there a limit on how many times they can meet with us?
Thank you for asking, Sarah. No, there is no fund fee. In fact, we would welcome you to come and stop by anytime with questions as much as you want. We will grab a cup of coffee, can go over, make sure that you understand your options. And throughout the process, as Randy mentioned, we are happy to meet with you as often as needed. And as maybe your goals change, right? Throughout your lifetime, maybe some of those needs and goals will change. There is no fund fee no fee to set up a fund. There is, just so that you understand, usually a 1% to 2% fund fee that would be once you established a fund. And then also an investment management fee for the funds, depending on what investment pool selection you chose for your fund, but nothing to get started, and it's super quick. So I know the year end is coming. We would be happy to help you and can usually accommodate new funds fairly quickly and within a matter of days or within a week or two, for sure.
Great, thanks. Greta, this question is going to come to you, and it was actually in the chat. So what sort of timeline do we have here at the foundation now that the giving season is well in swing and we're nearing the end of the calendar year? What would we want our professional advisors and donors to be aware of on funding timelines to get something new set up before the end of December?
Yeah, it usually takes a couple days. We can turn it around, but with it being the year end and year end giving and people thinking about charitable donations, we would like, if possible, for the clients to meet with us by December 15th, or at least get something on the calendar so we can plan ahead and know how many fund agreements will need to get done before the end of the year. But we do provide concierge level service. So if there's an exception, we will do whatever we can to accommodate.
Thank you. AJ, at this time of the year, we see a lot of stock as a gift to open a fund or recapitalize a fund. So if a donor or their advisor is going to be helping using a stock gift into the foundation, what are the steps that they should do to do that, and where can they find that information?
Yeah, thanks, Sarah. That's a really good question. We make it very simple and easy for the donor and their advisor to make a stock gift. So there is a form that is easily accessible on our website. So you can just go to communitygiving.org/stock gift information, or you can just go to our website, and on the top there's a giving tab, and then you can just click the sub menu that says for advisors. And then a nice form appears, and you can fill out all of the information and everything right there on our website. And it is submitted to our finance team. So we get it very quickly to help the donor and their advisor get that stock gift going.
Thank you, AJ. It's important to mention to everyone that because of the way the holidays fall this year, they are changing the normal course of timeline for gifts. So in our minds, we are trying to encourage all stock gifts to have begun transacting, because as Cheryl mentioned in her part of the presentation, it's not the day that you start the gift, it's the date that it gets to us. So we really want to make sure with the extended holiday that you start gifts by December 20th, as if it's a stock gift. Particularly if it's a mutual fund gift, we need just a little longer to transact mutual fund gifts. So December 20th would be the good rule of thumb for a stock gift to finish and be complete. So no one is starting 2024 with any concerns about that gift not being in our hands in plenty of time to trigger that 2023 tax receipt. So that's a good rule of thumb there. Greta, I have another question for you. what does the succession planning that we do tied to setting up funds, particularly donor advised funds, look like? And how does the foundation help potentially the next generation who will take over advising a fund?
That's a great question. We actually, when we meet with the donors the first time to set up the fund, we do talk through succession planning. They could have all of the dollars in the fund pay out at that time when they're no longer living. They can leave it to the foundation and let the foundation advise on it. And a really cool, practical experience that we had with one of our donors, the parents passed away and left the kids, the daughters, in charge of the donations after that. And what the donors did, the original donors, they had 50% of the payout each year designated to charities that they determined. And then the children got to pick what charities they wanted to give to in honor of their parents. So we met with the family, with the daughters, and they didn't even know what they were going to be able to give back and honor their parents with. And so it was really, we walk them through the process, and we meet with them once a year now and help them with their giving.
Thanks, Greta. That's a great story. Randy, you mentioned in your presentation about how the Community Foundation team is on the ground in community and has the pulse of what the local needs are. Can you say a little bit more about the ways that we learn about what local needs are so that we can advise our fund holders in real time?
Yeah, so we spend a lot of time in the community. We're working with different organizations, the nonprofits, the schools, government, businesses, right? So several organizations across all of our communities, and again, involved in different initiatives. So through that, one-on-one interactions or initiatives with them, we hear what the different needs are. And then working with donors, if they have specific passions or areas that they want to be focused on, we can help match that up. Recently, I had one in Painesville where we had a donor that was very interested in donating to education programs. And through our relationship with the school, we were able to match them up to specifically know where they wanted to give. Same thing with a veterans program in our community, matching them up with our veterans groups in the organization or in the community. So through all of our interactions and being on the street, working with these organizations, we're able to understand what's there and match them up with donors' desires.
Great. Thanks so much. I appreciate it. We want to also mention that we can work with a donor anywhere. So while our homes are in the greater central Minnesota area, if you are working with clients who do not call the greater central Minnesota area home year-round, they might be seasonal, or they might be the friend of a friend, that doesn't mean that your local community foundation that you have a relationship with cannot support them directly through a fund here at our community foundation. So that's a great spot to call and ask. We have donors who make gifts all over the country, in fact, even all over the world through their funds, as long as there's a US-based intermediary intact there. So we are sending out, I believe our chief finance officer said that almost $500,000 in grant making was going out of our funds this week alone. And that is going to only increase in the next couple of weeks as charitable giving really increases as well. We also want you to remember that there's no wrong door. So if the portal's not working, you can't quite decide where your dollars should go, or you're struggling with what kind of advice to give one of your clients, please tag one of us in. We are always happy to help and be your colleague. It is our job not only to pick out the tools in our toolbox that best meet the needs of your client, but also to be your partner in doing good and treating your clients as the trusted people that we want them to look at us as well. So that relationship that you've started with them, really, we want to protect that. We want to hold that, and we want to earn their trust as well. So there's no wrong question. There's no wrong door. Your executive directors are here to be your first line of defense on anything relative to charitable giving. The last thing that I want to mention before we turn it back over for some closing comments is, again, year-end dates for 2023 are a little odd. And normally we say every gift has to be postmarked on or before December 31st, but there will be no December 31st postmark this year because it is a Sunday. So please do help us by encouraging people to give a little bit earlier than they might often do, but know that our offices in Brainerd, in Wilmer, and in St. Cloud are all open on December 29th. We are happy to be able to assist our donors. And we would be encouraging, we'll look at every gift that is postmarked 2023 for a 2023 tax deduction and get that documentation out to them per our normal policies. If you have any questions, again, do give us a call. And I want to thank all of the executive directors for sharing their expertise today, as well as Cheryl. And now I'll hand it back to our CEO, Steve Jewell.
Thank you, Sarah. And as hopefully all of you can see, we have a wonderful team of experts to assist and support you in your charitable giving. Sarah said it, this is a wonderful time of year. We sign a lot of checks that go out the door, and we know that every single one of those dollars goes out to a charity and makes a difference in the lives of somebody. And so we just really very fortunate to be working with all of you as generous donors and professional advisors who care about your local community. And we want to thank you for being a part of today's webinar. I want to thank Cheryl Morrison. She's a wonderful resource. And if people have follow-up questions or want a direct link to connect with her, we'd be happy to connect you with her, as well as all of the fantastic executive directors serving their local communities. You see their pictures here, their contact information. They're always willing to help out and insist in working with you and or your clients in any way possible. We welcome your comments and feedback about today's webinar. And if you'd like some additional information about some planned giving techniques, that's available at our website at plannedgiving.communitygiving.org, professional advisors resources, and then also just comments, questions, feedback, please reach out to us at info@communitygiving.org, and we'd be delighted to hear your thoughts, ideas. We are planning to do another webinar probably in February, as well as another one also later in the spring, because we have found that we did a lot of these in COVID and then we kind of took a hiatus, but we have discovered that people still like to tune in and learn a little bit about what's happening at the various foundations. And so it's our goal to stay in touch with all of you and provide that information that hopefully helps make all of our communities better for everybody. So with that, we wish you a happy holiday season, and thank you so much for your generous gifts as well as your advice and work with your clients in helping them give back to their local communities. Have a wonderful evening. Thank you so much for being with us.